Thank you, Richard. Now, a while ago, we did a section on the Fed balance sheet as a predictor of the S&P 500, and I showed you this chart. And so net liquidity, which is defined as the Fed balance sheet minus the Treasury General Account and minus the reverse repo facility, and that's the green line, appear to have a very good correlation with the S&P 500. Now, before I get into this, a quick thank you to Uncle Tom on our Discord channel, who explained all this to me, and I think I now understand it. Hence, we're going through it again. Okay, so how do you define net liquidity? Remember that the Fed balance sheet comprises bonds that it has bought from institutions, giving them US dollar reserves in return. So one way of looking at the Fed balance sheet is that it represents money that has been made available to the financial system. The Treasury General Account is money held at the Fed that belongs to the US government and is the result of bond sales. So it is money that is currently unavailable to the economy because it is being held with the Fed for the government. So the TGA represents money withdrawn from the financial system. The reverse repo facility is money borrowed mainly from money market funds, not banks, as I previously said, on a short-term basis using bonds as security. And once again, it represents money that has been withdrawn from the markets and therefore is unavailable for other purposes. So in summary, the balance sheet, Fed balance sheet, equals money made available to the financial system. The TGA and RRP are money that has been withdrawn from the system. So therefore, net liquidity is the Fed balance sheet minus the TGA minus the reverse repo facility. So net liquidity will rise when the Fed's balance sheet is expanded by buying bonds in the market in exchange for reserves. The government spends the TGA, withdrawing money from the Fed and putting it into the economy, and the RRP is reduced as contracts expire and money is returned to money market funds and made available for use in the financial sector and the economy. So we see that there's an amazing correlation between net liquidity and the level of the S&P 500. And this is a chart from week 88 of Portfolio Matters, and it claims that there's an R squared of 89%, which is absolutely astonishing and means that 89% of the volatility of the S&P 500 can be explained by net liquidity. And if we believe that, that means that only liquidity matters, i.e. earnings don't matter, news barely matters, sentiment barely matters. The only thing that matters is that when the Fed either withdraws money from the financial system or pushes money into the financial system, that always seems to end up in the equity market, changing the level of the equity market. So we did that 2 months ago. How has it performed? Well, over the last 3 weeks, net liquidity has risen. And that is despite a fall in the Fed balance sheet. And it is because of a decline in the reverse repo facility. So money was returned to money market funds, who presumably put it in the stock market. And also the TGA fell as the government spent money that it previously raised from bond sales. So what happened? Well, as forecast by net liquidity, the S&P 500 rose. Now, there's also the question of causality. The data for Fed liquidity is weekly, and let's say that a money market fund decides it wants to buy equities and withdraws money from the reverse repo facility and then puts it into the equity market, you would see this correlation, but that correlation would be contemporaneous and have little predictive power. So, in conclusion, this relationship seems to work. However, does it have any predictive power? In order to forecast the S&P 500 using this relationship, you need to forecast net liquidity. Now, the only one of those components which we can forecast with any accuracy is the Fed balance sheet, which we know should continue to contract through QT. So if this relationship holds, we would expect that the S&P 500 should fall, but with some volatility because we can't forecast either the RRP or the TGA.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.